Welcome back, dividend investors. Today we're going to take a closer look at StarBucks, stock ticker SBUX, currently trading at $98. Over the last year, they are up roughly 15%. Year to date, they are down roughly 3%. And ever since their last earnings report 1 month ago, they are trading roughly sideways, down 3%. And it wasn't even a bad earnings report at all. They beat on the bottom line, but missed the top line. But let's take a close look at some of the dividend stats. You can see here they do offer forward yield of 2.16%, annual payout of $2.12, payout ratio just above the healthy of around 60%, 10-year growth rate of 11%, and a dividend growth streak of 12 years. And if you take a look at the history, you can see here it's how we want to see it, up and to the right. And as you can see here, they have paid out the same amount the last 4 times. So we are probably in for an increase for the next dividend from StarBucks. But to gauge the safety of the dividend, we jump into the financial statement. You can see here revenues are indeed growing. 2018 numbers around 25 billion, up to 35 for the last report or last 12 months. Jumping a bit down here, we want to find the net income, and you can see here it actually decreased a little bit. 4.5 billion back 5 years ago, 3.7 now. Not looking too good. Something we definitely want to look closer into why that is. Using that net income, we do jump into the cash flow statement where we can see here in the first line, coming down a little bit to the cash from operations. You can see here 2019, 5 billion, last 12 months, still 5 billion. Not looking too good, to be honest. Capital expenditures are roughly steady. Obviously, the last 12 months has been at a higher level due to inflation, most likely. So what we're looking at here is that they are not producing as much free cash flow as we would like them to. Coming down to the bottom in the free cash flow statement, in the cash flow statement, you can see here the free cash flow per share sits around $2.60. With the dividend being $2.12, there's not that much room to actually increase it in the future. But if we jump into the SimpliSafe Dividends website, a very nice tool for investors, quite expensive though, but it's nice. They do give a dividend safety rating for StarBucks dividend of 67. So they appear to be safe, at least according to the metrics they are using. And one final thing before we jump into the intrinsic value calculation, you can see here Wall Street actually has it as a buy. But if you jump over to the analyst breakdown, you can see it's mainly based on a 9 strong buy analyst and then 20 hold. So we are indeed having a lot of analysts who has it as a hold instead of a buy. But if you come down to the price target from the analyst, you can see they have it around $112, which it could indicate a potential 15% upside from the current levels. But jumping into our stock screener, we can see here that we do have a lot of different metrics. Some of them see here that the PE ratio forward is around 24. The PE ratio being 43 for the last 5 years, I would definitely need to look into that because I think this is mostly in line with the last couple of years, I believe. The revenue is growing as we saw earlier. We are sitting pretty much in between the 52-week high and the 52-week low. Net debt to EBITDA is a bit on the high side, but not too over leveraged, I would believe, but I would like to see this under 3. Return on invested capital and return on equity are looking really good. The return on equity, obviously not for the last report, sits around negative 37, but the 5-year average around 40. Those are really nice levels. The current yield is, as we mentioned, 2.16. 5-year and 3-year dividend growth rate sits just shy of 10%. Margins are looking pretty good, but they have been a bit under attack. You can see here both the operating margin and the 5-year CAGR has actually shown decrease. Not something we would like to see. Obviously, we would like to see increasing margins for a healthy business that can control their prices and raise them as they see fit. Jumping into the dividend data tab here, let's zoom in a little bit. What we're looking for here is some steady growth. You can see here a lot of the growth from the 10-year growth rate comes from the early years where they had around 23-25% increase. In the couple of last year, you can see they only had 6 and 8%. So it could indicate that the dividend growth status of StarBucks has decreased a little bit and they can't keep up the massive increases in the future as they've seen earlier. Obviously, there are some headwinds for a company like StarBucks at the current time, so we might see a small increase the next time. Coming down to the dividend yield theory graphs, you can see it could indicate there is a little bit of a discount at the current time. Whenever we are above the line, it could indicate that it is indeed undervalued, and the graph on the left shows that it could indicate a 9% discount at the current levels. We also have a lot of other valuation methods. I'm not going to go through every one of them. I just want to show that I do make a dividend discounted cash flow model. For this discounted cash flow model, it shows the fair value be $25, and using free cash flow, that is indeed the case. If you do a discounted cash flow for earnings based, then you get around $125 as a fair value. Using all the ones we do have, we do jump into a summary tab right away. So you can see here, I did exclude the discounted cash flow model. All the other average up to $86. The current price being 98, you could indicate the current discount is negative around 13%. But obviously there are a lot of estimations in these numbers. So as we saw with the PE ratio and the yield theory graphs, you can see this is probably fairly valued around the current levels. Obviously, we also want to have a little bit of a margin of safety, mainly due to all these estimations. As you can see here on the right, we do have our margin of safety calculator. We start with a standard of 25. Depending on some of the metrics you can see here, then we either add or deduct a little bit of margin of safety. We end up with a margin of safety of 10%. So let's transfer that over here. We then get the acceptable buy price being around $78. For me, that doesn't necessarily mean that it has to hit this price for me to buy. I already own Starbucks stocks and I would like to have more, but I would like to see a little bit of a pullback back from this $98. If it goes below 90, I will probably pick up some more. If it goes lower, even better, because I think Starbucks is a really strong stock. It has a strong value proposition, even in the uncertain times we do have. And I think it's a good company and that will execute really nice on their strategy going forward. Thank you so much for watching. Please leave a comment if you are already owner of Starbucks or could be buying at the current levels. I would love to hear it. Thank you so much for watching, and I'll be seeing you in the next video.